Okay, hello. Welcome everyone to our webinar. We're going to give it another minute here, let everyone log in. Why don't we talk about where everyone is coming in from? DJ, where are you at today?
I'm in Eugene, still.
Awesome. Jason, how about you?
I am in our Corvallis office.
Excellent. Chandran, I think I see a different scenery for you.
You mean as opposed to the beach scene that I had last week? Now I'm in lovely downtown Salem. It's nice and, well, it's cloudy, but it's bright and the weather's good.
But you're back in the office.
Back in the office, correct.
Excellent. And Matt, how about you?
Back in the office here in Newport. I think I can see you from here.
And I am in our Newport office as well.
Yeah, we're fortunate that in our offices, we've got enough space that we can do the social distancing and yet still be here serving our customers.
Yeah, all right. I'm just working on the technology. It looks like everything is getting ready here. And we are live. All right, everyone. So welcome to our spring webinar series. Today we are going to continue to give you market updates as they have changed day by day, week by week, always new stuff to talk about. We're also going to talk about retirement planning considerations and strategies, and in particular, as it relates to the Secure Act changes and creating a legacy far beyond your retirement and your lifetime. And then also at the end, we will talk about next steps. How do you take some of these ideas that we are going to share in our webinar today and actually implement them into your own unique situation? And we're going to be talking a lot about tax strategies, some complex estate planning strategies. So what I want to encourage you to do is maybe take out a notepad, and as we talk about different things, jot down some notes, and then afterwards we will let you know how you can get in touch with us or send us an email, and we will make sure, if we can't answer all the questions live today, then we will make sure to follow up with you one-on-one and answer those questions. But do feel free, there is a Q&A function at the bottom, and you will be able to ask questions as we go. Feel free to do that and put those in the Q&A. And let's get started. So first I want to bring up, I guess he can't walk on stage, can he? But I'm going to turn it over to Chandran.
Walk towards the camera if you like.
Chandran is our president and wealth advisor here at Financial Freedom Wealth Management Group. As you can see, he has extensive executive experience, a great background of companies that we have all heard of, including Dell, and he was also the CEO of Soft Choice and Gestetner Corp., which is awesome. He brought to us, boy, how many years ago? 8 years ago, I believe?
Almost 9.
Almost 9 years, a wealth of information and guidance and mentoring that we just all have fully embraced and love here at Financial Freedom Wealth Management Group. He actually wrote a book called Catch the Arrows, so you can find that on Amazon. And here's a picture of his lovely wife, Holly, who is also on our team, as well as Ferocious. Chandran, take it away.
Thank you, Julia. And by the way, our little dog Ferocious, we had to give him a name like that so he could fend himself against the world, you know. So the smaller and he's so ferocious he'll lick you to death as you get close. But, let me add my thanks to all of you for joining us on our webinar. We just love educating the public. It's something we love to do, and so thank you for joining us. Julia, thanks for the great introduction. I want to introduce to the whole world our CEO and founder, Julia Carlson. 20 years ago, as a teller at a bank, she saw a whole different future for herself, and she still built this company over the last 20 years. Not only did she do that, but she raised 3 kids and a husband. And as you know, the last of that is the most difficult job to do. That's probably your biggest accomplishment, really. You can see all the licenses she has, but if you look at the awards that she's won, as far as the financial freedom and leading this team, she has got great accolades around the nation from Forbes, from Investment News, etc. She's a columnist on the newspaper. She does a blog, and she's helped this team build up to where we are, where we serve our customers with a level of dedication that is, we think, second to none in the industry. So who is this company that she founded? Well, it's Financial Freedom Wealth Management Group. As I said, 20 years ago, we're independent and we provide a whole bunch of different customized planning solutions to families, businesses, individuals. Move on to the next slide. Thanks. It's coming. I think what's key, though, I just checked lately. I've updated my numbers. There's 330,000 financial advisors in the United States. I think I can safely say half of them can almost do as good a job as we do with investments, but very few, if any, are committed to a different set of values, a different set of purpose for serving the customers. We have no minimums because we want to help everybody that needs help. We have core values that we will go out of business before we violate. Treat all people with respect, never compromise their integrity, delight our clients, not just satisfied, delighted, and embrace a culture that we have of a team culture where everybody is focused on delighting the client. If you're a client, you can call anybody and we'll take care of you. All of our wealth advisors are part of a team. You don't have independent wealth advisors, different opinions. We have a collective wisdom that we utilize to do our investments for you. So our commitment is to care deeply about you and your financial life, right? And our focus to create a plan for your dreams and inspire you to pursue financial freedom of your own. Because that idea of freedom, which is what this whole country was built on, is a key component of being able to live a stress-free life, especially a stress-free retirement. We have 5 locations. We're about to have 6, actually: Newport, Salem, Corvallis, Eugene, Vancouver, and we just opened one in Portland with 5 wealth advisors that you see, 8 support staff. Our broker-dealer is LPL Financial, the largest independent broker-dealer in the country. Julia will tell you a little bit more about them at the end of this webinar. But they're wonderful because they're not only are they independent, but they have no proprietary products where they're trying to get us to put people's money into a particular product like a lot of other broker dealers. They're totally independent, giving us the freedom to serve our clients as they should be served. There's our team. It's a lovely team. There's my wife, Holly, sitting next to me, making sure I behave. And as you can see, the rest of it. As you can tell, we're also good looking. We only hire good looking people and smart, great team members. These are wealth advisors. There's from left to right, there's DJ, myself, Julia, Jason, and our newest member, Matt Beck. Matt, when I say newest member, you've been here, since last year. You're Series 766 life and health insurance. We went to Pennsylvania to grab him. We needed somebody with an Eastern accent, a little bit of people used to snow and shoveling snow to bring him up there. So actually, Matt came on vacation to the coast and went past Newport, Oregon, and said, "This is where I want to be." And it turned out we were looking for somebody just like him at that time. So we have a great opportunity to pick Matt up and be part of our team to help our customers. Matt, do you have anything to add to that?
Yeah, no, I think you said it perfectly. Thank you for the introduction. The idea was to kind of live where we want to retire. So I didn't want to make the commute from Pennsylvania to Newport. Here we are.
Oh, good. Well, welcome aboard. Welcome aboard. I'll let you take it from here, Matt.
Well, if I could introduce Jason, he is our resident MBA, CFP, and wealth advisor and vice president of Financial Freedom. And wonderful guy. I can say that with confidence. He, like I said, is our certified financial planner. He's got 14 years of experience with financial systems. He is our Dave Ramsey Solutions Master Financial Coach in 2012. His business experience was with Hewlett Packard, Portland, and Oregon State University. And of course, he's pretty involved in his community in Corvallis as a volunteer there. So he's a pretty busy guy with a wonderful looking family, by the way.
Thanks, Matt.
Of course.
Awesome. Well, we will get right into some market updates. And if you've tuned in to some of our other ones, I do have similar slides, but I promise some new information, some updated things to go over. But I want to talk a little bit about some of our current realities. As you've probably seen, unemployment is now nationwide at almost 15%, which is a little scary. As you kind of think about, those numbers don't include people that aren't looking for jobs anymore. So people that have stopped looking. So not only are we having economic concerns, but also just human concerns, right? Of how these things are going to work together. Also, people are not spending like they used to. Like the stimulus came in February, the savings rate was 8%. Now it's at 13% in last month. So we're seeing some things that are a little concerning, which can cause panic and concern. But hopefully by the end of my little chat, you will have a little bit more hope and excitement about what's happening, even if your pocketbook or your job is not showing the same thing. But what that means by the savings rate being so high is that we're not going out just spending money like crazy yet. We're kind of pausing and waiting and seeing what is really going to happen. So as you know, this has been a very deep recession. It dropped 35%, the markets did, and the low point was on March 23rd. The good news is that we have seen some of that come back, in fact, quite a bit. Last week, the S&P 500, which are your large top US companies, there was a gain of 3.57% for the week, which is another big uptick. And last time we chatted, there was also quite strong uptick. So does that mean it will keep going up? Who knows? In fact, we're going to have a polling question here in a moment that I'll let you decide what's happening in the future, and we'll talk about it. So we are at numbers that are the same as October, the start of October of last year. So we've already rebounded some there. And if you look back a full year, we're already higher than we were a year ago for the S&P 500, which is pretty impressive. So with that, I'd like us to take a little poll. I hope you play along with me here. There should be a little box that pops up on your screen if you're in our webinar. And we're going to do a poll of where you think the markets will end at the end of the year. So December 31st, what do you think the S&P is going to be at? And I'll give you a little hint. Currently, the market is down by almost 10%. So we're down 10%. Remember, earlier we were down 35%. So I'm going to get to see whether you're, thinking it's going to go back further down, which would be that first one. Markets will be down more than 20%, and then it kind of goes more positive from there. You might think the markets are going to be up less than 5%, 5 to 10, or up 10%. So just take a moment to click one of those answers, and I'll give you a few moments to chime in there, and then we'll see where people are landing. I think we'll be able to show it live once we're in there.
Yes, about 80% of us have voted so far. So
Okay.
take your best guess.
Yes, there's no wrong answer. It might not be the reality, but it's just fun to do.
I think so our last webinar was about 2 weeks ago, and the majority, I think, said the market will be down, 10 to 20% and or
Correct.
down less than 10%. So overall down around 10% at the end of the year. So I think we will close last 5 seconds. I'll end the polling here, and then we can share the results. So can you see?
Oh, wow. Yes. Okay. So it looks like we're a little more optimistic this time.
Mm-hmm.
So it's a tie between the markets will be up less than 5%, which is still a positive. That means you're thinking it'll be between 10 and 15% growth from now, or up 5 to 10%. Wow. That's impressive. What a big change a couple weeks can make. So what's happening is that, I mean, what we're reporting here, just in our little poll, is the change of how the markets actually price in that optimism. And so the markets are very forward thinking. And maybe some of you were on some the past call where we talked about that. So the question here, are we headed for a recession? Absolutely. Of course, we did these slides a long time ago when this was not happening. So the clear answer is yes, we are already in one. So let's look at some of this history that will hopefully give us just a little bit of a backdrop to help us see the future. So as you know, history tends to repeat itself, but not in exact repeating, more like rhyming. So as you can see, there are a number of red down bars there. These are drops of more than 20% in the S&P 500. So there's only 8 of them when you look over the 93-year history here, which is actually pretty impressive. And if you look, the time that it's in the red zone is a lot smaller than the big blue up bars. So what that is telling us is that these recessions, yes, they come, but they are short-lived, and they don't last forever like it feels like sometimes. These things pass pretty quickly. The largest one you can see there is the first one, the Great Depression. Pretty significant. The other one, which doesn't look as significant, is at the far other end. That was the 2008 Great Recession. And so it was a deep one, but it did recover fairly quickly. If you remember back then, about 3 years' time, and your markets were back up, but the economy was not quite back up yet. If you remember, jobs took a while to come back, and for people to feel confident, you know, and get back to work. So our guess is that it will probably be similar here. You'll see the market rebound a lot quicker than the economy will, especially with the significant unemployment rate and job loss. Okay, this is a very busy slide. There's lots of bars on here. I'll explain it real quick and we're gonna move on. This shows throughout a given year, the lowest that the stock market dropped in, you know, over these past 40 years. So you can see in 1987, there was a 34% drop. So that's similar to where we are looking at the lowest this year. 34% drop throughout the year in the yellow bars, and then the blue ones show where the market actually ended for the year. So even though we went down 34% in 87, the year ended at a positive 2%. That December 31st was positive 2. And you can see a similar was in 2002, also 34% down. Didn't quite make it out of the out of the low, but still it didn't stay at 34%. It was down 23% to end the year. And as you can see, that next year was the positive year, along with a few others, 26% return in 03. So this just shows that, okay, we had a 35% drop, but it is very unlikely that we would go lower than that to close out the year. In fact, it's never happened in this 40-year look back. The lows are just throughout the year. So that gives you a idea to look at and consider as you're thinking about what to do. Also, looking back at that 40 years, the average return over those 40 years was 14%. Average was 14% return on just large US companies. So if you stuck in there and stuck with it over the past 40 years, like let's say you just had a coma and just kept it in there for some reason, didn't know what to do, boom, you made 14% per year, which is pretty impressive, even through all the ups and downs. This one shows another look at, after a market decline of 10% or more, what does the S&P 500 do the next year, 3 years, and 5 years? And as you can see, it's positive. It's great. 11% return on average after a decline of 10% or more that year. And 5 years, you're still 9.6% per year for 5 years. Pretty impressive. I would say if you're not needing that money, you want to stay the course, because the markets have always rewarded long-term investors. Now, let's say you might be taking money out. You might need to be a little conservative. And of course, we're looking at your portfolio as you're doing this to help guide you and make sure you're on the right track. But let's see what happens after these big recessions and things. What's happened to your portfolio if you're part stocks and part bonds, which means you have an aggressive piece and also more conservative piece? Well, look at that first one, the market crash of 87. 1 year later, you had a 19% return. And this is with a balanced portfolio, which is great. And then 3 years later, average of 11% return. 5 years later, average of 15% return. That's amazing. Let's look at 2008, because it wasn't as nice as that, but still good. Look at that. A year later, 4% return. 3 years later, still an average of 4%. And then that 47% is 5 years later, you average 9.4% per year with a balanced portfolio. So this is how we help you stay the course, by looking at what makes the most sense for you. This might not be your exact portfolio, but we would be looking at ways to make sure you have the income and that you stay invested into the plan that we set up for you. So if you were going to get a 9% or 14% return over the next 5 years, would you hop in and do it? Definitely. So I would definitely encourage you to make those moves that make sense for you. And if there's nothing that you're supposed to be doing, then it's staying the course. A lot of times we let our emotions kind of drive the train, as I like to say. So you've got the optimism, then you're excited. You're like, yes, markets are doing great. Let's put money in. But then you put it in at a high, and then things start going down, and you get nervous, and then the fear sets in, which is where a lot of us were a month or two ago. But that's not the time to make decisions based off of fear and panic. In fact, when things are on sale, that's the time to hop in there and to make the most of it. So if you think about it now, the S&P 500 is on a 10% discount. It's probably a good thing to hop in, because it's most likely to go up, and probably by the end of the year, we'll see some increase there. So what we're seeing now is there's high optimism in the markets. The key now is to be patient, to focus on your plan, focus on what's most important for you, and let us guide you through this journey into the next steps, because we will get through this, and the markets will come back quicker than the economy, and we will all be in a better place, hopefully sooner than later. So if you do have any questions or things that you want to talk about with any of these market slides, again, you can put it in the Q&A box, or we'll have details on how to send that to us after. So with that, I'd like to invite to the screen DJ Wright. He is one of our wealth advisors, and as you got to hear, he's our Eugene native and graduated from my rival school, but I still find him amazing. University of Oregon. And there he is with his family there. He loves his 4-year-old son now, Oliver. I'm glad we got an updated picture. That's just
Me
lovely.
too. So much better.
So there they are having some fun. And yeah, DJ is fully licensed, manages a lot of our portfolio investment research and decisions. And so we're super glad to have him here as he talks about some of the retirement planning considerations and kicks that off.
All righty. Thanks, Jason. Appreciate it. So yeah, we're going to talk about some retirement strategies to create a legacy. Right? Most of us want to leave something behind, so we're kind of going to focus on that here. Making the decision to retire is probably one of the biggest decisions we all make in our lives. Now, unfortunately, it's not just one decision, but many big decisions we have to make. You know, we're living longer and longer lives, which makes these choices bigger today than they have been in the past. And they not only affect you, but your legacy as well. So it's very important to think it through, and that's what we help you guys do. All right, one of the big ones everybody knows is Social Security. So here we have a chart of how the program has varied over the years. So this is showing how many active workers are actually paying into the program versus how many people are taking benefits. So in 45, there were 50 workers to 1 retiree. That's incredible. Then in 85, right, more people are working longer. Now there's 3.3 workers for every 1 retiree. And it's expected that in 2030, we'll have 2 workers for every 1 retiree. So with Social Security, you know, it's not like you pay into the program, they hold it for you, and then they, you know, pass it on over. You know, you use it when you're in retirement. It's just a transfer of wealth. And so you can see some of the concerns for future benefits that a lot of us have. So of all retirees out there, 40% of their income actually comes from Social Security. And the other 60% comes from, you know, things like employer-sponsored retirement plans, 401ks, and then also our personal savings. So these are like your, you know, Roth IRAs, traditional IRAs. So it's important to take into account your full retirement picture, including what other assets you have when you're evaluating when to take Social Security. There's a lot that goes into that, and they kind of affect each other. It's also important to consider how your decision affects your spouse, right? That's a big one. So we have a great Social Security planning tool for helping couples decide what's best for them based on their unique situation. So you're probably all wondering, right? When should I take Social Security? Well, the answer is it depends. There's never an easy answer. So part of our tailored solution for our clients includes Social Security, and we'd love to help you evaluate your options there. All right, next slide there, please. So when you retire, or when you're about to retire, there's generally 2 types of retirement plan distributions available to you. So there's the pension annuity or a lump sum distribution. Now, some of you may only have one of the options, but if you have both, you'll want to evaluate what's best for you in your specific situation. So a pension annuity is basically a stream of payments that generally continues to pay until you or both you and your spouse pass away. So some of these have survivorship options. It is generally taxed as ordinary income, and you can't change it, right? You're essentially stuck once you make that decision. So with the lump sum, you can take a full distribution and pay all the tax. They're gonna automatically withhold 20%. Probably not the best idea. But what generally makes, is a better idea is to roll that into an IRA. This allows you to continue that tax deferred growth. And the big thing is you now have control over these assets, right? Control over the investments, control over the distributions, much more flexibility than, say, a pension might give you. And next slide, please. So here we compare the annuity pension versus the lump sum distribution. So, I mean, we've found a lot of times it makes sense for people to take the lump sum, again, for the flexibility and, just having more control. However, there are scenarios where the pension is the best. Or sometimes, if it's an option for you, taking a combination of part pension, part lump sum can be ideal. So again, this is all stuff that we will talk through with you and look at all your different options and help you make the best decision there.
All right, I think I am going to step in here, and I know we have a couple questions coming in. I think that we'll get through some of this part, and then it's really good questions. Then we'll come back and answer those. So as we start thinking about not only the decisions that we make at retirement, which DJ just talked about, but we also have to think about the long term and the inheritance of your assets to your children. If you don't have children, it could go to your favorite charity, your favorite nonprofit, extended family. I know some of our clients choose to maybe even skip a generation and go to grandchildren and do college planning. They can get very fancy. So, but the bottom line is, we like to ask the question, who would you rather disinherit? Your family, your favorite charity, or the IRS? And oftentimes it just takes proactive planning to ensure that your assets do what you want them to do, as opposed to leaving it with no planning and to chance. So last webinar, we talked all about the Secure Act and the major changes that were a part of that, and the real consequence of the 10-year rule. And so as a recap, if you didn't listen to that webinar, we're gonna go over that here briefly. So in the good old days, before the Secure Act was in place, you were able to, what we refer to as, stretch out your IRA to your beneficiaries over their lifetime. And that is now what has changed. So we are no longer able to stretch an IRA over our beneficiaries' lifetime. In most cases, which there are a few exceptions, which I'll talk about, but in most cases, your retirement accounts that are left to the next generation have to be distributed within 10 years of the owner's death. So over 10 years, that has to be liquidated, which is a real impact, because we have had a lot of clients over the last 20 years that have passed away, and the intention is that that income would be available for their children's lifetime. And so this is a big change that applies to all IRAs, as well as to Roth IRAs, which we're going to talk about. The exception, of course, is a spouse. So you can still leave, in most cases, the beneficiary on your IRA is a spouse if you're married. And so between spouses, you don't have to start liquidating that IRA and get it all liquidated within 10 years. The other exception is if children are under age 18 and you leave the beneficiary is to the children, then what they would have until their age 18 then they would have 10 additional years. So from 18 to 28, but they would have to take that money all out during those 10-year period, which most likely is not the best time to take money out at that age. So, and then if you know, disabled, chronically ill, there's some other exceptions, but for the most part, for clients that have adult children, they will be forced to take that money out over 10 years. And so that's what we want to talk about, some strategies of how do we think about that? How do we retain that income tax deferral? Well, a lot of these decisions are based on your income tax rate. And so what I wanted to talk about and cover is how does our tax structure look currently, and then what could potentially happen down the road here. So currently we have 7 tax brackets in the United States. You can see here up the middle of the pyramid, 10, 12, 22, 24, those are the tax brackets. And then on the right or the left, depending on if you're single or married filing jointly, you would find your taxable income. And what your taxable income is all of your income sources minus your deduction. And most of us take the standard deduction now, where if you're married filing jointly, it would be $24,000. If you're under age 65. If you're over age 65, then it's a little bit more. So let's say a couple makes $100,000 minus their standard deduction of $24,000. So that would be $76,000 would be their taxable income. So for them, they would fall into the 12% tax bracket here. Now, if they made, let's see, $4,000 more, you can see they would jump over to the 22% bracket. So every dollar is taxed at a progressive rate. So the first $19,750, you're taxed at 10%. The next, from $19,751 up to $80,250, you're taxed at 12%, and then so on. So it's progressive. So you could figure out your effective tax rate by determining how much taxes total that you're paying. So 2 different things that we look at. We look at what tax bracket you're in, and then what's your effective tax rate. The other thing to note here is that if you are in the 10 or 12% tax bracket, then your capital gains rate is 0 currently. If you jump into the 22% bracket, then your capital gains rate goes to 15%. So that's something when you're deciding the type of investments that you're investing in a non-retirement account, these are the things that we have to look at to determine what makes the most sense for your tax situation. The other thing I want to note is that the current tax brackets that we have and tax rates went into play in 2018. And right now they are scheduled to sunset in 2025. And so you can see here the difference between, if you just follow a color, that will show you what the tax ranges were in 2017. So you can see we're paying a lot less taxes currently than we were in 2017. So the 12%, most Americans are in the 12% bracket, which used to be the 15% bracket. So that will get defaulted back if changes are not made to the tax code. And I think with all of the stimulus money that has gone into the system, one of the ways to balance that in the future is higher taxes. So I think if you That's a good poll, Jason. We should add that. Next time is, what do we think taxes are going to do in the future?
Exactly.
Yeah, most likely go up. And so if we can take advantage now and over the next few years here, 5 years that we have to take advantage of these lower income taxes, that might make sense for your situation. Okay, so we're going to introduce the Roth IRA. So I'm going to turn this over to Matt, where he's just going to talk about the basics of what a Roth IRA is.
Thank you. Yeah, I don't want the tax brackets to change, but they just need to let that go. But anyway, we love the Roth IRAs. It's one of my favorite types of IRA. You know, with the Roth, everything that you put in is post-tax money. So that's after you've already paid taxes on it, on your earned income, when you get paid. So that has a limit of how much you can put in every year. So it's the same as it's going to be for a traditional IRA. Up to 50, you can put in the $6,000 per year. Over 50, of course, the IRS gives you a catch-up amount of $1,000 currently, so $7,000 for 2020 on both the Roth and traditional IRA. With the Roth, though, when you take your withdrawals out, unlike the traditional IRA, where everything is taxable to you at that time, as long as the money's been in there for 5 years, everything that you take out is going to be tax-free. And then after 59.5, of course, they waive any 10% early withdrawal penalty. And the great thing about the Roth, too, is that there are no RMDs. So you get to preserve that wealth and preserve that legacy for even longer. So again, for legacy planning reasons, Roths are great. And if you do leave the Roth to a beneficiary, they get to take out that entire account, again, within the 10 years or after you've turned 18, if you're a minor, 10 years of 18, as Julia mentioned. But those distributions, so again, they're not taxable. They all come out tax-free to you. So just great tax planning tools and great other buckets of money to use for that reason.
Excellent. So there are 2 ways to get money into a Roth IRA, because that's a very common question we get. I hear so much about Roth IRAs. How do I get one? 2 ways. So you have earned income, but most likely in retirement, you don't have any more earned income. So the other way to do this is what is called a Roth conversion. Now, Roth conversion isn't an all or nothing thing. So Roth conversions are meant to be spread out over many years and taking advantage of lower tax brackets. So it's past lunchtime here and I'm kind of getting hungry and I'm looking at that peanut butter. So it's all about spreading it out. The worst thing you can do is go and convert 100% of your IRAs out there. Not good planning. So what we like to do is really spread it out over years where it makes the most sense. So going back to the tax brackets that I talked about, and if you're a married filing jointly couple, and let's say your taxable income was $50,000. Does anyone remember what the top of the next, or the, what was the top of the 12% bracket? Any of the advisors remember? 76,000, give or take. So from 50,000 to 76,000 is $26,000 there, where you could convert part of an IRA, a traditional IRA, over to a Roth IRA and not go into that next tax bracket, okay? And what that does is it allows you to pay taxes at 12% currently. So you do have to pay the taxes. It's best that you have money outside of your retirement accounts to pay those taxes. So there is some strategy and some number crunching that you have to do here. But if you could pay 12% now, and we know in the future tax rates most likely will be going up, that's taking advantage of these lower brackets now. And then thinking longer term for your children, let's say your adult children are making 100,000, 150,000, and you're in retirement making a lower amount. So if you pay taxes currently on this money and get it over to a Roth, then later on when they inherit it, that income won't be added on to their income, and they could be up in that 28 or even 30% plus tax bracket. So these are some of the things. Every situation is different. So I just want to caution that you just don't want to go converting out there, but it is a really good tool that we can use to get money and shift it over to a tax-free bucket. All right, so I think DJ, you're gonna talk us through this case here.
Yeah, so this is basically just showing what you just said. So, you know, thinking, should I convert my pre-tax money into Roths before I pass away so that my beneficiaries can inherit a tax-free Roth bucket, essentially? So if you're in a higher tax bracket than your beneficiary, don't do it, right? Then you'd be paying tax at a higher rate. Your beneficiary could have paid it at a lower rate. That usually doesn't make sense. And so that's that top scenario there. Now, excuse me, if your beneficiary is in a higher tax bracket than you are, you may want to consider these conversions. So this is like, maybe you have a son or a daughter who's a doctor, and they're in that top tax bracket. You could spread out some Roth conversions while you're retired and not working and pay lower tax, get it into that Roth bucket, then they inherit it and they don't have to pay any tax. So it's not going to add any income for them. And so that can be a really great way to pass money along tax-free.
Yeah, very good.
DJ is chartered here. Also, that comment Julia made that by, or is it 2025, it could go up. So that's a double benefit here if you're in a lower tax bracket and it's before the potential tax increase that might be automatically happening.
Mm-hmm. Great point.
Absolutely. And we have a special rule for 2020 with the CARES Act that makes that if you do not have to take a required minimum distribution. And so a lot of our clients will have a lower income year in 2020, where again, this may make sense that you just, instead of taking the RMD, that you just use it to convert it over and get some money in this tax-free bucket. Very good. Okay, another kind of rule of thumb that in the financial advising world, we've always kind of assumed, I would say, that spouses are each other's beneficiaries. And so that's just kind of default. If I'm married, you know, my account goes to my husband and his account comes to me. Well, now with this 10-year rule, what happens is most likely spouses don't die at the same time. And so all of the money gets held into the surviving spouse's IRA, which could have considerable assets in them. And so if there is a couple that is financially independent and they have plenty of assets to last their own lifetime. So again, you want to work with an advisor that can ensure that. That would be for sure very important. But then it may be best practice for, if there is enough wealth within couples, that when one spouse dies, they actually leave their IRA to the children at that point and bypass the spouse. And then that way there's a 10-year drawing period for the children at the death of their first parent, and then a second 10-year period at the death of the second parent. So again, this is a new strategy that we are considering if it makes sense for our clients, but you have to make sure that you have plenty of money for the longevity, that you have plenty of money for potential long-term care, medical expenses. There's a lot of things that go into making this decision. And then another strategy that we are seeing is using charitable remainder trusts. And what that means is that as an IRA, that you name a charitable remainder trust, And that is an entity that is set up upon your death, because that would be listed as the beneficiary. And what that charitable remainder trust does is it pays payments over the life or up to 20 years of your children or beneficiaries. And then at the end of that period, the value of the IRA drops into a nonprofit charity of the IRA's choice. So the original IRA owner can name that charity. So again, this is another way to provide income for your children, but then ultimately still get money to a charitable organization. So we're seeing more of this, because with those, you can control the lifespan of the income. So again, very complex strategy. We wanted to just throw the idea out there, but if you are interested in something like this, please reach out to us and let us help you really understand if this is the right fit for you or not. So as we've talked, every situation is unique and different. We thought this was a cute image of that. There is no one size fits all. And I think that the next step here will be to determine and work with us to figure out what is the tailored solution for your situation. So before I go through the close here, I thought I would put out some questions so we can talk about these as we get closer to time here. So the first question is, how does investment strategy differ between someone's need to leave a legacy for beneficiaries versus someone who doesn't have heirs? How do we utilize the equity in a home with and or without a current mortgage? There's a lot of questions in this one. Is it better to pay off the home and use the asset for income? Do reverse mortgages require the home to be paid off? That's a lot of questions. All right. So I would say yes, for sure. The legacy strategy is very different for someone that has heirs and doesn't. And then you have to determine, do they have a legacy they want to leave, like a charitable organization? So those would be some of the questions that we would ask. And then as far as utilizing equity in the home, reverse mortgages are a tool out there. I would say that we would not give blanket advice about that. That would be very specific to your situation. Reverse mortgages do not require the home to be paid off. There are a lot of different options for those. And I would say, as far as paying off the mortgage and using the asset for income, we would revert back to it's best to create the plan where you're saving for retirement and making sure that your retirement is on track before you pay off your mortgage. So does anyone want to have any more comments on that? No? Okay, well, go ahead.
Well, just kind of maybe adding to it, because it seems like this might be asking about utilizing some of the income from the home, but keeping the home as an asset, if you can, is nice, and then passing that on gets that step-up basis, so there's not the tax situation and those sorts of things. So just something to consider as part of the planning. Yeah.
Well, if we didn't answer your question, reach out to us. We will help work that scenario through. Mm-hmm. Another question is, what happens if the charity goes out of business during those 20 years? Where does the balance go? Great question. So within that charitable remainder trust that gets established, there would be guidelines and successor charitable organizations that you would name. And you can also name a successor trustee that would have the ability to help facilitate any changes that needed to happen as well. But great question. Okay, so I'll finish us up here, but if you have any more questions, please put them in the comments or the Q&A. So our process is we do have a process. It begins typically with an educational encounter like this, not only for friends that are not clients of ours yet, but also for our clients. You know, this financial journey changes, as we've seen in the last 6 months, 3 months really. So it's a guided journey that we take our clients on, and we always lead with education. And so it's learning about you, it's discovering what your unique needs are, and then creating that tailored solution and implementing that, and then making changes as needed. LPL Financial is our broker dealer. They are the largest independent broker dealer in the United States. And as Chandran started off, in the beginning, he was talking about how independent is the key word. They don't have proprietary products, so we are able to use investments that we feel are the best fit for our clients. They are part of SIPC, which is Securities Investors Protection Corporation, which protects investors if LPL were to fail. Your money would be protected by SIPC. It's also important that LPL is the custodian of our clients' funds. So your statements don't come from Financial Freedom Wealth Management Group, they come from LPL. And that is very important in protecting you as an investor. So as you'll find our services listed on our website. You'll have a complete menu of services, but we offer not only investment management, but a lot of the strategies that we talked about today, these legacy planning, retirement planning, when is the right time to collect Social Security. I've worked all my life, I have this nest egg, now how do I create a distribution strategy? These are all things that we work with our clients. And so I would encourage you to look into that. And if there's anything that you need help with, we are happy to do that. Also, as we move into this more virtual world, we would love to get your feedback. It's hard to get the feedback without looking at everyone's faces, but we've had good feedback. We want to continue to do these webinars. So if you have any topics that you want us to cover, please send us an email to financial.freedom@lpl.com. Any feedback we welcome, and we will be sure to include that in our future events. And then lastly, if you are a friend here on our webinar today, or a client, and you want to talk with us more about these strategies, please either call our office here at the number provided, or again, email us at financial.freedom@lpl.com. And with that, I will open it up. We'll stay on here for any other questions that come in, but as thank you for, oh dear, I'm going the wrong way. But thank you for tuning in, and we will look forward to seeing you in the future, and be healthy and safe. There we are. There's the last page. All right. Have a good day, everyone.
Bye.
Take care.
Bye.
Bye.